Most new investors meet the same fork in the road: buy a broad index fund or choose individual stocks. One path spreads money across many businesses. The other concentrates money in a few names. The emotional pull is different too. Individual stocks feel like a story. Index funds feel like a system. In this video, we compare both tools through risk, diversification, fees, behavior, and practical decision rules, without naming any specific fund or stock as a recommendation.
An index fund is built to track a market index. The index is a basket of securities meant to represent a slice of the market, such as large companies, small companies, bonds, or a broader economy. An investor cannot usually invest directly in the index itself, so the fund becomes the vehicle. Some funds hold nearly every security in the index. Others sample the index. The key idea is simple. Instead of trying to select one winner, the fund tries to follow the basket. That basket can still go down, and it still has risk, but the risk is spread across many holdings, rather than one business.
A share of stock is an ownership claim on a company. That means the investment depends on the business behind the ticker. Sales, margins, debt, competition, management, regulation, and the price paid for future profits. A great company is not automatically a great investment if the market price already assumes perfection. A weak company is not automatically cheap just because the share price is lower than before. Individual stock investing is the work of connecting a business story to a valuation and then accepting that the future can still surprise everyone.
Diversification is one of the clearest differences. With one stock, one company-specific problem can hit the whole position. A product failure, lawsuit, debt issue, accounting problem, or sudden competitive threat. In a broad fund, one company can fail while the basket continues. Diversification does not remove market risk. In a broad bear market, the whole basket may fall, but it can reduce the damage from a single business being wrong. This is why the question is not only what can grow fastest, it is also what can survive when individual outcomes disappoint.
Stock market outcomes are often uneven. A small number of large winners can create a meaningful share of long-term market wealth, while many companies produce average, weak, or negative outcomes. This creates a hidden challenge for stock pickers. It is not enough to avoid obvious bad companies. The investor also has to own enough of the rare, extraordinary winners and hold them through uncomfortable volatility. The hardest part is that the winners are obvious only after the chart has already been drawn. An index fund handles this problem by owning the basket, including future winners before they become obvious.
Fees and expenses reduce returns because the money paid in fees no longer compounds for the investor. Many broad index funds are known for low ongoing costs, although not every index fund is low cost, and every fund document still deserves attention. Individual stocks may not have an expense ratio, but they can create other costs: spreads, taxes from frequent trading, research time, and behavior mistakes. A zero-commission button does not make a trade free if it encourages constant activity. The lower-cost path is the one that keeps both visible fees and hidden behavior costs under control.
The time commitment is very different. A diversified fund strategy can be maintained with a simple process: decide an allocation, invest regularly if appropriate, rebalance when needed, and review the plan. A stock portfolio asks for more work. The investor may read annual reports, earnings releases, valuation notes, competitor data, debt schedules, and industry news. That work can be interesting, but the market does not care whether a person was busy, tired, or distracted. If the research process is weak, confidence becomes a poor substitute for evidence.
The math is only half the story. Individual stocks can attach to identity. When the price rises, the investor may feel intelligent. When it falls, the same investor may feel personally attacked. That emotional bond can lead to doubling down, panic selling, or ignoring new information. Index funds can reduce that identity pressure because the decision is less about proving one company right and more about participating in a broad market process.
The psychological advantage is not excitement. It is humility, repeatability, and a plan that can survive a bad news cycle.
Consider a hypothetical example, not a prediction. Imagine $500 invested each month for 30 years. The contribution alone equals $180,000. If a portfolio averaged 6% annually, the ending value would be far lower than if it averaged 8%. If the path included deep drawdowns, the emotional challenge would be even bigger. This example is not saying any investment will earn a specific return. It shows why time, contribution behavior, fees, and the ability to stay invested can matter as much as the headline return number.
Individual stocks do have a real advantage: concentration. A well-researched position in an exceptional business can outperform a broad fund by a wide margin. That possibility is why many investors are attracted to stock picking. But concentration magnifies both insight and error. The same structure that creates large upside can also create large downside. A concentrated portfolio asks a hard question. If this thesis is wrong, how much damage can one idea create? Without position sizing and risk controls, ambition can quietly become fragility.
Many investors do not treat this as an all-or-nothing decision. A common educational framework is core and satellite. The core is a diversified base built from broad funds. The satellite is a smaller area for researched stock ideas. The purpose is not to declare one side perfect. It is to separate the foundation from the experiment. A person who enjoys business analysis can still keep most of the plan diversified, while using a limited portion for individual stocks. The exact split is personal and depends on risk tolerance, time horizon, and discipline.
A broad fund can reduce company-specific risk, but it cannot remove market risk. During a broad sell-off, even a diversified index fund can fall sharply because many companies are being repriced at the same time. This is where expectations matter. If someone believes diversification means the line only moves upward, the first bear market feels like betrayal. A more realistic view is that diversification changes the source of risk. It can reduce the impact of one company failing, but it still leaves the investor exposed to recessions, interest rate shocks, valuation changes, and investor fear. Index funds are simple, but simple does not mean perfect. Some indexes are concentrated in a few large sectors. Some funds have higher fees than viewers expect. Some may track the index imperfectly. Some may hold companies an investor would not personally choose. And because most broad index funds are market cap weighted, the largest companies can become a major part of the basket. These are not reasons to panic. They are reasons to understand the tool clearly. Every investment structure has trade-offs, including the one that looks easiest.
Taxes vary by country, account type, and personal situation, so this section is only an educational framework. Frequent buying and selling can create taxable events, and tax friction can interrupt compounding. Many broad funds are designed with low turnover, while an individual stock investor can also be tax efficient by holding patiently. The real problem is unnecessary activity. If every headline causes a trade, the portfolio may leak value through taxes, spreads, and mistakes. A plan that requires less action can sometimes be easier to execute consistently.
Another quiet feature of index investing is turnover inside the basket. Companies can enter, leave, shrink, or grow based on the index rules. This means the fund is not frozen forever in yesterday's winners. It changes as the market changes. That can be useful, but it also means the investor is accepting the index methodology. The fund is not making a judgment about which business is morally better, more exciting, or more popular online. It is following rules. Understanding those rules helps the investor know what is actually being owned.
A broad fund approach may fit investors who value simplicity, diversification, low maintenance, and a process that does not depend on predicting one company. It may also fit people who know that they do not want to read earnings reports every quarter. That is not laziness. That is self-awareness. A plan that matches real behavior has a better chance of surviving.
For long-term goals, many investors prefer a system they can repeat through normal life. Work, family, stress, market noise, and periods when investing is not the most important thing in the day.
Individual stocks may fit someone who genuinely enjoys business analysis, has time to study, can size positions responsibly, and can change their mind when evidence changes. The work is not only finding exciting companies, it is comparing expectations against price, tracking risk, reading filings, and staying humble when the market disagrees. A stock picker also needs an answer to a painful question: what would prove the thesis wrong? Without that answer, a position can become a belief system instead of an investment process.
Imagine two fictional investors. Investor A owns one broad basket. Investor B owns 5 individual companies. In a strong year, Investor B might outperform if 2 picks work extremely well. In a weak year, Investor B might underperform badly if one company has a major problem. This example does not prove one path is always better. It shows the trade-off. Concentration creates a wider range of possible outcomes, while diversification usually narrows that range.
There are myths on both sides. One myth says index funds are risk-free. They are not. Another myth says stock picking is only gambling. It does not have to be if there is serious research and risk control. A third myth says the exciting choice is automatically smarter. Excitement is not evidence. The educational takeaway is to separate tool from behavior. The same tool can be used wisely or badly. The investor's process often matters more than the label placed on the product.
Before choosing a path, a useful self-audit has 5 questions. How much time can be spent on research each month? How painful would a 40% decline in one holding feel? Is the goal learning, long-term wealth building, or entertainment disguised as investing? Are fees and taxes understood well enough to avoid unnecessary drag? And most importantly, will the same plan still make sense after a bad headline week? These questions do not produce a universal answer. They reveal whether the investor is choosing a process or chasing a feeling.
So, which is better? For many people, the better question is, which process can be followed through stress? Index funds may fit investors who want simplicity, diversification, and low maintenance. Individual stocks may fit investors who have time, skill, patience, and a clear risk process. Neither tool removes uncertainty. The market does not reward confidence by itself. It rewards a repeatable process, sensible costs, emotional control, and risk management. Before choosing, ask 3 questions. Do I understand what I own? Can I handle a bad year? And does the plan fit my real life?